Good morning and welcome everybody. Thank you for joining us. My name is Lawrence Gosling. I'm the founding editor of Investment Week. Some of you may even read my column, Gosling's Grouse. But it's not about me today, it's about the world of multi-asset investing. So I've got two experienced practitioners with me to talk about some of the issues that we think are relevant to you. So firstly, Toby Nangle from Threadneedle, welcome to the programme. Toby,
thanks so much.
I can get my words out. Multi-asset words are struggling. And Solomon Dark from Architas. Again, Solomon, very nice to have you on board.
Thanks, Lawrence. Solomon Nevins.
Sorry, no, goodness me, your colleague is Harry Dark, isn't he? I'm getting very confused. Right, well, guys, you can see our audience is, our panellists are on the ball, and I am not. Let's get stuck into it. Toby, to start with, this whole issue, we've been in a period of, it feels like real volatility sort of since the beginning of August. Before we get into how the sort of multi-asset funds have been kind of dealing with that, would you agree with me that the world feels a little bit more volatile than it did perhaps this time last year, or is that just the media creating the noise around the volatility?
No, it's certainly not the media. I mean, there is a much more volatile environment.
Yeah.
Since around about the time, I mean, the thing that actually really kicked it off was the Chinese depreciation. When that came through, it seemed to scare the horses in the markets.
Yeah.
Partly because people were concerned that there's not very much growth in the developed world.
Yes.
All the growth coming from emerging markets, perhaps that's going to become in a devalued currency and be remitted as such. And also you could get emerging markets undercutting developed markets with China joining the pack there. So that's created like one massive, huge risk trade, which has been pulsating ever since, to be frank.
Yeah.
Periodically sort of calmed by central bank action that we've had. So it has been a very volatile time. It's been quite a tricky time, but actually it's probably the sort of time where multi-asset funds should be proving their worth by navigating that environment for investors.
And that's going to be the nub of what we discuss as we go through the debate. I mean, Solomon, from your perspective, I guess you probably would agree with sort of Toby's kind of synopsis of the last sort of few months. And I guess just thinking ahead, we must mention the word Brexit. It feels like we're going to carry on with this sort of period of uncertainty, volatility, however you want to describe it, at the very least until we have a sort of Brexit vote. Would you agree with that?
Yeah, I'd agree with that. So we've clearly seen volatility in sterling since fears around the UK leaving the European Union increased. We haven't seen so much in the equity market. UK equities have been one of the strongest performing regions. We think that's more to do with kind of commodities than issues around Brexit, given the high allocation to mining and energy companies in the UK market. But we think that as we get closer to June the 23rd and the two campaigns for Remain and Leave intensify their activity, trying to convince voters one way or the other, we could see financial markets in the UK particularly reacting to that in different ways, and perhaps we could see the volatility we've seen in sterling also present in equities and in gilts.
And Toby, let's come back to this sort of issue about how multi-assets should and have performed in that sort of period. So, give you a little plug. Talk about the portfolios that you run for Threadneedle. How have you done in the last sort of 6 months or so?
I mean, as you say, it's been a tough 6 months, but over the 6 months, we're pleased to be in a reasonably good place. When I say a reasonably good place, it's not shooting lights out in terms of total returns, but my multi-asset funds across the spectrum are a little bit softer over this period, and we're pleased to be a little bit stronger for our clients. We got there really by ensuring that as we go into these risk periods, if you think before risk events, everything seems nice and rosy, the signing up plans. At those times, we've been scaling down risk. So when everyone has been moving to one side of the boat, we've tried to move towards the other side. And then we use periods such as August last year, January, February this year, when risk assets performed very poorly, to look and scale increases in allocations to those assets that we've got fundamental belief in. So we've done that, and then as markets have rocked around the other ways, and as suddenly everything's happy and everything's all right, so we've slightly scaled down risk. So we try not to be particularly trady. We try to invest over 12, 24, 36-month periods. But when you get a 15% move in valuation in a given month, that prompts sort of valuation signals to really start to shift our allocation. So that dynamic allocation is how we've been able to deliver positive returns over this period.
And Solomon, what have you and the team been doing with some of the Architas portfolios over this sort of period? And I appreciate I'm talking very short term at the moment. We'll get on to sort of perhaps a more longer term perspective in a minute.
Sure. So generally within our portfolios, over the past year really, there's been an element of de-risking in portfolios. So just on a longer term basis, thinking that we've had an extended period of economic recovery and market recovery, and valuations just aren't super attractive across the board in the equity market. So although an opportunity presented itself in the middle of February to add a little bit more risk on after the sharp pullback, our general trend is to take a little bit of risk off the table in the equity market, and perhaps to offset that with slightly larger allocations to bonds and less risky investments there.
And Toby, you just mentioned in your last answer, which I thought was a really good point. Multi-asset funds are not trading funds, are they? I mean, the idea. I mean,
some are. I mean, there are so many different styles.
Yes.
I mean, that's one of the problems I think for advisors. That when they think about multi-asset, you have this proliferation of different styles. We try not to. I mean, our style is not to be tradey. It isn't kind of go in on something on a Monday and then by Friday sell it out. Pat yourself on the back and go and play golf. It's about investing for that medium-term horizon, which our economic forecasting process and valuation process is geared towards, which tends to be pretty slow-moving over time. We're eyes to the horizon as we walk forward. So new things should appear on the horizon. We also should have the humility to say we were wrong if something doesn't work, and no point in keeping it in the portfolio for an extended period just because we thought erroneously that something was going to develop. But we should be investing for that medium-term horizon, and it has been a little bit more high turnover over the past 6 months, but precisely because the volatility in the market has been such that you get really compelling valuation opportunities, and then when those just disappear, there's no reason you should continue to hold something just because it used to be cheap.
And Solomon, you're not looking to do trades like buying the Brazilian stock market 3 months ago, which is if we'd all done that, it'd be a great trade. That's sort of it would have been the easiest 30% we'd all made this year type stuff. But you're not trying to do very, very specific things like that are quite high risk by nature. As Toby says, you're looking for a more sort of steady, longer term, I guess gradually accrue performance over 18 months, 2-3 year sort of period.
Yeah, I think that's right. So the majority of our portfolios at Architas are a risk profile portfolio. So we're trying to help our investors hit long-term investment objectives. So we use an asset allocation model that looks forward 15 years, and that's where we're looking towards to hitting those objectives over that longer period. But as Toby mentioned, when volatility picks up in the market, that does present some shorter-term opportunities, and it's right to react to those, but in a controlled way that doesn't prevent us or jeopardize our ability to hit those risk and return targets in line with clients' expectations.
Okay, let's dig into a couple of questions that have come in already. Very nice question from Paul McCarville at Serious Investment Solutions. Thank you very much for this question, Paul. To you, Toby, are multi-asset funds managed to specific volatility targets or ranges destined to sacrifice return? So, first question to you, do you have any sort of risk or volatility ranges within your portfolio?
So Dynamic Real Return Fund, which is one of the funds I'm mentioning already, what we're trying to do is deliver real return of 4%, so CPI plus 4 over the medium term with up to 2/3 of equity volatility.
Okay.
So if you like, the equity can be from 0 to 75, commodities 0 to 20, bonds and cash from 0 to 100. Now, you could say, well, if you had a higher conviction strategy, if equity is doing great, well, why wouldn't you be 100% equity? Yes, potentially there is upside that we're giving away by clipping out a maximum allocation to risk assets or risky assets, and we do that through a whole variety of risk systems that you might imagine, thinking about sort of VAR shocks, these sorts of things as well. But actually by structuring an investment process to participate in strong risk markets and then being able to hunker down when things are not so great. So in environments, let's say equities go up 20% over the next year, we're doing a pretty good job if we're up 12. If equities are down 20%, we won't be patting ourselves on the back, but a reasonable job will be down 5. Combining those asymmetries of participation protect over time gets you to that CPI plus 4 type environment. And it might be that people want something a bit more aggressive than that. In that case, there is other things to go for. But I think that knowing where you stand and knowing where you're aiming for is very helpful when you're managing a portfolio, because then you're never sort of filled with regret that you simply should have done it 12 times as much with leverage or all this sort of stuff. So it's probably horses for courses type answer.
Yes.
And I don't think that we've been sacrificing returns by actually sticking to this disciplined investment process and then changing our risk appetite as the price of risk has developed.
Solomon, similar question to you. Again, I know you as a group have a range of products, some of which are kind of similar to Toby's in terms of how much risk appetite or risk budget rather that you've got.
Sure. So yeah, in a similar way, we focus on targeting risks rather than targeting volatility rather than targeting returns, and we feel that that's a more controlled way of investing and is more likely to get a return profile in line with the client's expectations than their appetite for risk. By targeting a very high return, that might work well in some market conditions, but consistently trying to pick up these very high returns will eventually lead you into very risky areas of the market, and inevitably that will result in large losses. So we feel it's a more controlled approach to target a level of volatility or risk, and using that budget, allocate to areas we feel that are most effective, but doing so in a diversified way that maybe sacrifices some return in order to maintain that diversification and that controlled risk profile.
And in terms of sort of income type generating portfolios, I guess to extend sort of Paul's question, sort of Toby, if I, as an advisor, am looking for a specific income target for my clients, and we all know income is a very important part, am I then going to give up something for achieving that 4 or 5% or whatever the figure is?
Well, the multi-asset income universe of funds is a much newer set of funds in the market. I mean, there's a few that have been around for a long, long time, but really, the chance of standing up and abolishing the requirement to borrow an annuity a couple of years back was the big wake-up call to the industry of saying, well, actually, there is a potentially quite interesting demand going to come down the stream for post-retirement drawdown type products, which have got a high demand for income. So we launched one very soon after that announcement. And it's pretty straightforward investment fund that uses active asset allocation. And I was always a bit of an income skeptic, thinking, why would you go for an income strategy when I can manufacture income out of total return if I wanted to?
Yeah, exactly.
And that manufacture, I think, is a bad thing to go for. However, if you combine investment styles which are income generative out of the way in which they have their investment philosophy, it can be really interesting. So our equity income strategies at Columbia Threadneedle, they use an investment process which is really about seeing how management are focusing on cash flow generation.
Okay. Yeah.
So it's really about how do you invest towards companies that are really focused from a management perspective, rather than should we go and buy something because it's got a high dividend.
Right. Yeah.
So on our Global Multi-Asset Income Fund, we're combining high income strategies, which are about targeting management behaviour on the equity side. On the fixed income side, it's towards where are you being overcompensated for default. And then also bringing in property part of our business, which actually at Columbia Threadneedle, we're a big property manager. Yes. And it's very income orientated. So, if you wanted to get exposure to London Prime, we would tell you go somewhere else. Right. Instead, it's to high yielding, small regional commercial properties. And again, that's very much part of the investment philosophy. So we launched a multi-asset income strategy, which was not about giving up return in order to get those income targets, but rather combined a variety of investments which were high income by their nature, that came out of the investment philosophy, if you like. And so that's actually worked extremely well, and it got best multi-asset fund of the year last year, which we were quite pleased about.
And Solomon, I know, Architas, you look for some of these sort of alternative investment areas, don't you, for one or two of your income products? I'm thinking of infrastructure and various sort of other things. With those kind of strategies, as an investor, are you giving up something for that sort of higher level of potential income from some of those underlying investments?
So many of those investments that would fall into this kind of alternative income category that you're describing there are their income plays, really. So there's often not a huge amount of capital growth baked into those stories, as all of the cash flow generated by those investments typically paid out as a form of a dividend. And if that dividend is of a high enough level, that's fine. Where we use alternatives within our multi-asset income portfolios is as a diversifier alongside allocations to equities and bonds, where we can get capital growth from. And our approach really, when putting together multi-asset income strategies, is to do so with a target income between 4 or 5%, which isn't so high that you're backed into a corner faced with a limited selection of investments. And by keeping a target that's very much achievable using a broad range of investments, you can maintain that diversification and be able to rotate the portfolio in a somewhat dynamic manner. We have some concerns about the areas that investors focusing on just traditional assets with a very high income target are faced with. So generally they're pushed into quite high risk areas such as dividend stocks, high yield bonds, emerging market debt, or at the other end of the scale they're buying very long duration government bonds. So whilst this barbell has some diversification, we feel like by taking some alternatives exposure, you can get a better level of overall portfolio diversification, improve the risk return profile.
How do you deal with the illiquidity that comes along with some of these things?
Sure. So clearly owning infrastructure projects in an open-ended fund format is ultimately going to end in tears. We're very focused on ensuring that the liquidity of the underlying assets is appropriate for the investment vehicle. So for our infrastructure exposure, we often use investment trust market. So this is where the fund manager has gone to investors like ourselves with a plan for buying assets, and we'll provide capital which is then used to buy the assets, and then in exchange for that we receive shares. And should we wish to leave the investment or add some more exposure, we'll do so by trading our shares on a secondary market. So what that means is our liquidity is a function of the shares liquidity on the stock exchange rather than the liquidity of the underlying asset, perhaps infrastructure.
Okay, let's get into, gentlemen, some more of the questions from our audience already. Toby, to you sort of first, from Paul Hayward. Thank you for this question, Paul. In terms of hedging against interest rate rises, you can, of course, go short. I don't think you can in your products, can you? Got any shorting?
No, I mean, the Dynamic Real Return Fund and also Global Multi-Asset Income Fund, they're long only, they're unleveraged. But I think the points about interest rate, if you finish the question, will probably still stand.
This is it. I was going to say, you know, how do you both manage the kind of the issue of the sort of interest rate rises and what it might sort of do to the portfolio? I mean,
no, I think it's a really great question because I mean the market is so focused on the idea that there's going to be no rate rises. Yes. If you look out in the UK market, I think the market is pricing the first rate rise in 2020, and a good prospect for a cut coming through. There are two members of the MPC kind of talking in the background about the prospect for a cut, to my mind, that's in the price. Right. That's now in the price. And so if you think there's going to be the first rate rise pushing out to maybe 2021, 22, 23, 24, then there could be some good value in interest rate duration. Yeah. As it stands, we don't have very much interest rate duration in the portfolio because we see the prospect of more rate rises than the market expecting in the US and in the UK, but not necessarily in the Eurozone or indeed Japan. And as such, while a lot of sort of traditional diversified growth funds might have a bunch of bonds, a bunch of equities, a bunch of this, that, whatever, put it together, and there's a natural diversity there, we haven't been relying so much on the historical negative correlations between bonds and equities to persist through time. That is to say, our fixed income exposures are much more short duration, so as in lower levels of duration rather than negative duration. So we've got quite a lot of exposure to short-dated BBB corporate bonds in the UK, which are basically unloved by pension funds because they don't have a lot of interest rate risk, unloved by insurance companies because they're capital intensive, have got a lot of roll down, so will never make us rich, but but makes a better part of the portfolio than some longer duration instruments.
And you're playing that view either directly or through another collective investment vehicle?
So when we use, in the funds I manage, whenever there's something which is idiosyncratic corporate level risk, so like BP versus Shell, that kind of stuff, I delegate those corporate level names to colleagues. So I've got a fantastic investment grade desk, a fantastic high yield desk, different equity desks, but we use internal funds, and that keeps it, from my perspective, really efficient in the way in which we have a joined up view of the world from an investment philosophy perspective. I get a look through on a risk management perspective, so our risk systems will go down to the single security level within each fund, and they'll show how they all integrate together, And then lastly, it's extremely cheap. We do that whenever there's idiosyncratic corporate level risk on the equity or the fixed income side. But anywhere there isn't, so for example, government bonds, we would simply put that directly.
Yeah.
Or controlling the currency, we would do that directly. Even some passive.
You're almost answering one of the other questions about currency hedging. Don't spoil that one.
Right. I'll just add some kind of follow-up thoughts to that question about interest rate risk. So I think one of the things that's been very interesting is that really since the financial crisis and the start of aggressive monetary policy, quantitative easing and very low interest rates, people have been preparing for higher interest rates in portfolios. So there's been massive popularity in floating rate strategies, so loans and also strategies that can go short duration. So huge amounts of assets have flowed into absolute return bond funds. And both of these really have been the trade that never was. Neither have delivered the kind of returns investors were expecting. Yeah. And that's a function of just what's happened to the interest rate backdrop, really. So clearly, coming up for 8 years since the crisis, we're still in a position where most central banks are either at very low interest rate levels, or and are continuing to print money, or really are still aren't quite at a position where they're looking to change that. And as a consequence of that has been bonds have been a great place to be invested in portfolios. We're of the opinion now that like Toby, where valuations are at the moment, you don't have a huge amount of protection really against a pickup in interest rates. So we think that if you buy into the idea that what central banks are doing will eventually be successful, then inflation must come through. And in that scenario, very expensive government bonds, particularly in the Eurozone, could be a very painful place for multi-asset investors to be. So it's something we're looking at more and more in terms of introducing inflation protection because it looks cheap, because investors aren't really expecting it. But still bearing in mind that this trend for very low interest rates could persist for a while longer, and that it still makes sense to have diversification in portfolios from some government bonds.
Okay, lovely. Good answers, guys. Let's come on to a question on excuse me, Japan from Mark Cooper at Clarity Financial Planning. Thanks for this, Mark. With the Japanese central bank now owning 70% of its government bonds and even 10% of the Japanese equities, are you still willing to commit investors' money to such a distorted country, says Mark? You don't have to comment, Toby, on whether it's distorted country. I think he means from an investment perspective, but Japan.
No, it's a great question. I mean, I take issue with some of the figures. The Bank of Japan is clearly seen to be the dominant force in the JGB market, and it absolutely is. Yeah. As a proportion of the stock of Japanese government bonds, it owns around about the same proportion as the Bank of England owns of gilt market, so around about 35% rather than 70%. But it's also intervening in the equity market, and they're battling with a multi-decade problem. And the big shock overnight, of course, has been that they didn't do something more radical, and that they thought we'd wait and see how things developed, and which has sent the yen to the moon and hurt the stock market. Although when you combine those, it's actually outperformed the FTSE today, which is kind of interesting. But yes, the case for Japan. I think there is a case for Japan, and I've got exposure in portfolios to Japanese equities.
The equity market,
because basically there's a valuation angle, there's an earnings angle, there's a corporate governance angle. If you think about, let's start off with the corporate governance angle. When I say corporate governance, I don't really mean it in an ESG sense. I actually mean in terms of capital discipline returning to that market. It was always a market which had bloated levels of cash. Some astonishingly high proportion of market cap sits as cash on balance sheets at corporates. That is on an exponential basis being returned to shareholders now. So if you take the last set of dividends and annualize that, which have actually been almost doubling each time, so that would be conservative, we're talking about a 5% combination of dividends and buybacks now per annum coming out of that market, which is a huge change.
Yes.
Huge change.
And are you also sort of talking about this kind of gradual unwinding of this sort of cross-holding structure that seems to have been sort of unique to a lot of the older school Japanese businesses?
Well, I mean, sort of return on equity is now in the Japanese corporate vocabulary, if you like. So there's a greater focus on return on equity than there ever was. And when we go out into sort of not only Tokyo but also all of the secondary cities to go and see companies, we see some very interesting things going on. And so if you combine that and look for world-class companies, some of them are Japanese.
Yep.
There actually is a place. If you then kind of go beyond that and kind of go, well, there is a big macro policy angle here. The macro policy angle is that they are keen to escape deflation and have so far been unable to do so convincingly.
Yep.
But it's only that last word, convincingly, which is the issue. Because I mean, there was a decade of deflation, and since Abenomics has started, they've actually been having positive basically non-food and energy inflation, which hadn't been the case for a long, long period. There is a re-rating angle which could occur, which hasn't happened, because Japanese earnings have actually risen faster than the Nikkei over the past 3 years. It's pretty much the only market in the world which is actually outperformed others and also become cheaper relative to other equity markets. So I think there is an interesting valuation side. But yes, of course there are risks.
Yeah.
There of course are risks, and some of those risks are policy risks coming through.
Solomon, exposures to Japan in any of your portfolios?
Yeah, we do have exposure to Japan for much the same reasons as Toby's explained. We feel that the Bank of Japan and the government are fully committed to really pushing all forms of policy and monetary intervention that they have at their disposal to try and get the economy going again. So after 20 years of really stagnant growth and low inflation, they're trying to break this cycle of consumers and businesses thinking tomorrow is going to be worse than today. And the policies they're doing, we think, give them a good chance of eventually being successful. And things like introducing a negative interest rate should eventually start encouraging corporates to stop hoarding cash and to put that into the economy and start using it for productive means. And we feel that there's the potential for it to become a more positive virtuous cycle that's self-fulfilling and lead to improved company earnings and shareholder returns.
And let's come on to this issue just generally, Solomon, in portfolios of currency hedging. Sort of Toby began to touch on it, and I sort of cut him off a couple of minutes ago. But what's your approach to the currency exposure?
So we don't have a currency hedging overlay. So we regard it as a decision we make when buying our underlying funds. So all of our portfolios are fund of funds. So when taking exposure to different bond or equity market regions, the decision really is whether to take the exposure of the local currency or to hedge that, or to buy a hedge share class and to eliminate that part of the currency risk. So it's something we think about. The majority of our clients are UK based, so we want to allow the investments rather than the currency to do most of the to determine most of the return profile. But where we can see clear opportunities for hedging, we will do so. So Japan's a good example. For much of the last few years, when the Japanese central bank was very aggressive in the early stages of their monetary policy announcements, we hedged that exposure back to sterling. And we've taken that off more recently, as clearly the impact that the central bank's activities are having perversely inverse effects. But it's something we consider, but it's not a core part of our investment strategy, currency hedging.
Toby, same question to you, but also, if you would, question specifically for you from Chantal Lee, I think, as to where your dynamic real return fund is currently positioned from a risk perspective, and where do you think the potential growth areas are? So currency first, and then the current sort of positioning.
Yeah, I mean, I sometimes sit on the other side of the table from fund managers as a trustee of an investment, a charity which has got an investment trust. And there's a real bugbear that I have of someone coming along saying, "Oh, we got everything right, but who can predict currency? So it costs you money." My approach to this is that as fund manager, you are responsible for all of the returns that come through. If there's a currency risk that you're not comfortable with, you remove it from the portfolio. And as such, when we're investing, we will only take those currency risks that we feel comfortable with. Now, generally, I tend to feel pretty comfortable from a sterling base investing in global equities, or as in equities outside the UK, on an unhedged basis, because the firms that we typically invest in are global firms with global revenues and more domestic cost bases. So you have a bit more of a domestic cost base, there is a currency impact. So if their currency weakens, their profitability will increase, their share price will go up, and there's a kind of a natural hedge there. Whereas on the fixed income side, if we own Australian government bonds because we're concerned about the way in which the Chinese economy as demand for commodities might come through and the way in which that would feed through the interest rate structure of the Australian yield curve, it would be bizarre not to hedge that because those same concerns would inform a concern about a weaker Australian dollar.
Yeah.
So we typically, I mean, not always, but typically would tend to leave equities unhedged and hedge overseas fixed income back to a sterling base. But we can do a little bit more active management around that. So if you'll remember back in middle of 2014 now, when sterling was going to the moon, and every idiot knew that it was going to go to 2 to the dollar. I mean, that was just absolutely given. And it got up to about 170, 171, that sort of level. We felt that the risk return was becoming quite asymmetric. There was a lot of people moving to one side of the boat. And so we actually hedged some of our UK equities into dollars. At that point, went beyond our natural exposure to dollars and hedged into dollars. And then as sterling came down, and it came down to 150, and everyone knew it was going to parity. So again, it wasn't that we had a strong view that suddenly sterling was going to do really well, but rather it seemed asymmetric, so we removed that. So we do some active management beyond that on the currency side, but it's in order to be accountable to our fund holders and our clients.
And some of the broader positioning on the your dynamic real return funds,
So we moved from a relatively defensive position in February to a bit more of a balanced position now. So when we think about our investment process, we're thinking about out of the scheme of returns to risk, will they be relatively high, relatively low? At the moment, we've got a variety of relatively risky assets in the portfolio. Our equities sum to around about 32% of NAV at the moment. We've got a little bit of commodity exposure, some property exposure, and have increased our exposure to European high yields, which was, I guess it was 0 at the end of 2014, but still 10% at the end of 2015. That came up to 15%. So we increased a variety of these risk exposures to those sorts of levels in February this year. And so the way in which we're sitting is relatively constructive as to the returns to risk, but without the kind of levels of confidence that would lead to a much greater level. I mean, just to give you some, I mean, the fund's been going almost 3 years. The highest level of equities just in that relatively short period of 3 years has been just a bit north of 50%, and the lowest has been sort of high 20s, that sort of level. I would expect over a full market cycle it will get down to 0 and up to 75.
Right. Okay. Solomon, we've got a question about gold. Have you got a view on gold? Do you hold it at all in any of your portfolios?
Yeah, we've got a small allocation to gold. One of the portfolios I manage is called the Architas Diversified Real Assets Fund. This is a portfolio purely of alternatives, predominantly real assets. So we've got a position in that portfolio in gold, and really that's it's a hedging position. So we feel that in an environment where bonds are very expensive, in periods of market shock, gold could perform that role perhaps more better than bonds can in that environment. Also, we feel that as central banks are increasingly bringing interest rates into negative territory and continuing to pump money into the economy, the value of money is continually being eroded. So this store of value in gold, we feel it can be valuable. And at current valuations, it's still a long way down from its highs in 2013, about $400 down. So we feel there's some protection there, perhaps more protection to the downside than you would have in investment in government bonds, which, if interest rates were to increase significantly or the dollar got a lot stronger, which tends to be a bad environment for gold, we don't feel like you'd lose too much cash.
And Toby, sort of question to you first, and then to Solomon. Given the kind of nature of all the events we've been talking about, a lot of it has been going on. As a sort of question from Doug Branson at sort of GAM. Has your portfolio turnover gone up in the last 12 to 18 months? And if so, what's the effect on the TER?
Yeah, no, the portfolio turnover would have been a bit higher over the past 12 months than previous because there have been more valuation opportunities that have come along. In terms of the TER or OCF in the new world,
yes,
we actually we have it capped at 50 basis points. So basically, if we're getting more costs that have come through it as associated with with turnover in terms of transaction costs and like that just basically eats down our management fee.
Right.
So it's my ideal day is never doing a trade, or rather doing a trade only over sort of a 3-year cycle, which maybe is a paradox for someone who manages a dynamic real return fund. But we don't hold ourselves up as traders, but it's the environment that sets the level of turnover, so it has been higher for that reason.
On that point, how difficult is it to, I'll use the expression, avoid the temptation to be regularly doing something because so many things are going on in the market, and I'm sure you get a lot of sort of questions similar to the ones we're getting today. Is it sometimes you find it a little bit difficult not to do things because you're not reacting just to what's happened to the day, but the trend? I think you sort of.
It's a great question, because there is this thing of, if you're a fund manager, what have you actually done today?
Yeah, exactly.
You've only sort of earned your living if you've actually changed something today, which is what you had. The real thing that made me sit down and think about this, I mean, I've been managing portfolios for about 18 years or so, was about 10 years ago. I was asked by an investment consultant to go back and rack through attribution of a portfolio over a previous sort of 10-year period. And I was doing that, and I realized that actually taking monthly snapshots of allocations gave mere single basis points difference in terms of total return if you assumed that you only traded 1 point in a month, at the first day of the month, to the actual timing, and the obsessing that we do over whether something's slightly better value at 20 basis points higher or lower. And it really made me think, golly, I need to expend my intellectual energy and direct my team's intellectual energy on the things that matter, which actually is often not going to be the day-to-day trading, changing. That will have a hard cost attached to it, and an unknown benefit, and instead focus on those issues which do have those 18, 24-month payoffs, which will be meaningful rather than clipping here and there in a more or less successful way. You're competing with some of the hardest place to compete. You're competing with day traders, market makers, prop traders, if you're doing that on a day-to-day basis. I prefer to be using the advantage that my clients give me, which is, say, a medium-term environment, to compete for what I think is much lower hanging fruit, which is big opportunities over the next 24 months.
And Solomon, to you, I mean,
yeah, I think that's right, and it is tempting when there's a lot of fear in the market to get a bit spooked and twitchy, and to and to move the portfolio around far more than you would do in calmer conditions. So I think it's important to have a team around you that can talk you down when you're when you're thinking about something which perhaps is somewhat irrational. But also to collectively have a view on where you think the world is going beyond this period of volatility, and whether the event that's taking place at the moment has derailed that in any significant way, and whether that's presented a genuine opportunity to change something or not. So I think it's being kind of clear in your mind about what it is you're trying to achieve and what your views are about certain asset classes, and then just not getting caught up in kind of headlines and hype, and just focusing on your core beliefs.
And the risk of getting caught up in a little bit of sort of hype, Solomon, and then off to you, Toby. Global equities, been sort of good momentum since the sort of beginning of the year in that asset class. What's the sort of house view of how long that may continue, and what are the sort of allocations you've got to global equities within some of your product?
So we talk about global equity markets just in general. Well, clearly, it's been it sounds cliched, but a year of two halves. So the first 6 weeks of 2016 were a pretty horrible experience for equity market investors, and then from that almost to Valentine's Day, things have been a lot more happy and rosy for equity investors.
Too many puns in this answer, by the way.
And I think a lot of this is hinged on what people expect from the US dollar and what people expect from commodity markets. So coming into the end of 2015, the guidance from the Federal Reserve was for 4 rate hikes this year. And following the big pickup in volatility around the end of that year and the start of this year, the Fed have backed off a bit and have cited global financial markets as a reason for perhaps lower level of interest rate hikes this year, and that has had an impact on the dollar. The dollar has depreciated a long way, and that's given emerging market assets a bit of breathing space, and that has been quite a significant driver for equity market returns and the recovery, we think. The other factor is the commodities market. So whereas we're all kind of trained to think that lower oil prices means higher growth means good, this year the experience has been positive correlation between equity markets and the oil price. So and this is continuing at the moment. So it's whether the interest rates in the US can stay low enough to sustain a weak dollar, and if the oil price can continue its appreciation, its increase, and taking equity markets with it. Now we think that the US economy is still in pretty good shape, and it hasn't deteriorated enough for all interest rates rises to be off the cards, and as a consequence we'd expect coming into June that expectations around an increase in interest rates at that point may start, and that could derail some of the supportive backdrop for equity markets we've experienced this year. So I don't think it's a given that this momentum in equity markets persists through the rest of this year.
Okay, Toby, what's your view on this? Would you share Solomon's that this is not going to be a momentum-driven sort of year? It's going to be another, I guess you would sort of say it's sort of a cautious type year, that as an investor you shouldn't be expecting double-digit returns by the end of. It's just going to be a sort of steady one if you can get through it like that.
I think that sort of choppy sideways markets feels, well, certainly the environment we've been in for a little while now, and we're not calling for a big breakout from that. We've got to remember that, I mean, risk premium in equities are still there. Valuations are higher than they have been in crisis times, but actually they're not actually ridiculous, underpinned by relatively low yields. But we think that those relatively low yields on the government bond side could start to reverse, maybe not as early as June, but there is that prospect out there. So yeah, we're relatively constructive towards global equities. Within our funds on multi-asset income and the dynamic real return fund, we're kind of taking a little bit more geographic segmentation than that. But relatively constructive actually about global equities.
Okay, gentlemen, we're coming down to the last sort of 2 minutes, so let's sort of do our sort of closing thoughts. Solomon, I mean, it would strike me from our discussion that one of the takeouts perhaps for the audience is when you see a fund or a group of funds in the multi-asset space, you like perhaps try and really understand what the manager is trying to do. I hear instances where people select funds based on the name, and I kind of go, I'm not entirely sure you get what this fund is doing. So understand what the manager is doing, sort of, so that they know what you can hopefully deliver for the client.
Yeah, I think investors need to be clear on what multi-asset income funds are trying to achieve, and whether that's targeting a specific risk profile which is going to be fairly fixed over the long term, or whether it's going to be far more dynamic in terms of the amount of risk it can add or remove. I think that's important. I think investors need to understand the costs they're paying, and what the manager of the multi-asset fund is permitted to do. So whether they're just investing in in-house funds, or whether they're taking a whole-of-market approach, and whether they're using a dynamic allocation between perhaps active and passive funds, or whether they're doing the direct investments in bonds and equities themselves. But I think it's having a clear view on what is the risk profile of this portfolio and the general exposure at the moment, and how well does that align with what my clients need to achieve.
Toby, any sort of final thoughts? I mean, I guess you would probably absolutely agree with everything that sort of Solomon said there. Well,
I mean, there is a wide range of multi-asset funds, and there is competition amongst them for clients and investors, but they are quite distinct. And so just understanding where your manager's coming from, whether you need to have levels of transparency or whether you don't need levels of transparency, whether you can sort of defend those positions to your clients, or whether you sort of feel that that's not something which you need to do yourself because you've set up the risk profile. I mean, these are all decisions that advisors that I speak to up and down the country are pretty well versed in, and I think that there's a good amount of understanding of this in the marketplace.
Excellent. Gentlemen, thank you very much. Right, we'll try and, for the benefit of our two panelists, get their names right at the end. So Solomon Nevin from Architest. Solomon, thank you very much. His colleague is Harry Dark, so you get two for the price of one if you invest with Architest. And Toby Nangle from Threadneedle. Toby, mentioned one of your colleagues, just in the interest of balance. That
Maya Bandari works with me on the wire fund.
Fantastic. So gentlemen, thank you very much for your participation today. Thank you very much to the audience. If you have any other questions you'd like to put to our two panelists, I'm sure they'd be happy to pick up on afterwards. If you would like to listen back to this at some point in the future, it will be on the Investment Week website, so you can share it with your colleagues. And for all those of you who are using or considering using multi-asset investments, I hope they work for your clients. From me, Lawrence Gosling, thank you very much.